In this video, we're going to talk about all of the things that you can do and some of the things that you should do once you turn 65. Coming up next on Holy Schmidt.
Holy Schmidt!
There are 4 ages in a person's life where they've earned the right to do something or they have the obligation to do something when they hit that age. That's age 18, 21, 59 and a half, and age 65. Each one unlocks something. Each one changes the rules. And if you don't know what happens at each age, you could miss something that costs you real money. For decades, age 65 has been the magic retirement age in the U.S., and honestly, it still is, but not for the reasons that you think. Now, here's what I mean. Every week, I talk to people who are approaching age 65 or who have just turned age 65, and they say basically the same thing, and that is Medicare kicks in, and probably this is the age, or perhaps this is the age, I'll start taking Social Security. And that's about it. But there are 4 other benefits that unlock at age 65. One wipes out a penalty that many people don't even know exists. Another is a brand new tax deduction for $12,000 for a married couple that some tax preparers don't even know exists. And then there's the trap, because right in the middle of all of this is a tax penalty, and the IRS doesn't send you a warning notice that it's coming. All right, let's get into it and start with one that most people think they know, and that is Medicare eligibility. And to be candid, a lot of people get this point wrong because of some timing issues. At 65, you become eligible for Medicare Part A and Part B. Part A covers hospital stays, skilled nursing, and hospice. Part B covers doctor visits, outpatient care, and most preventative services. If you're already enrolled in Social Security, you will automatically be enrolled in Medicare. But if you're not enrolled in Social Security yet, then you need to actively go and enroll in Medicare. And timing matters. If you miss the timing, you could face penalties. Now here's the timing mistake. Your initial enrollment period is 3 months before the month that you turn 65, the month that you turn 65, and 3 months after the month that you turn 65. It's a 7-month window. The exception to that is if you're born on the 1st. Then everything moves back 1 month. So if you were born on September 1st, Medicare assumes you were born in August. If you miss the window, then Medicare charges you a penalty on your Part B premium. That penalty is 10% for every 12 months you go beyond your eligibility, and that 10% is permanent. There is one exception, and that is if you're working or your spouse is working and you're covered on a large group plan, 20 employees or more, then you don't need to enroll in Medicare. But it has to be active work. It can't be a retirement plan, and it can't be COBRA. The next timing mistake is one that could cost you a lot of money if you get it wrong, and that's the choice between original Medicare plus a Medigap plan or a Medicare Advantage plan. Original Medicare is a government plan. A Medicare Advantage plan is an insurance company plan. Original Medicare is federal. Advantage plans are run by private insurance companies. Advantage plans often have lower premiums but come with networks, prior authorizations, and restrictions that can become serious problems when you actually get sick. Original Medicare with a Medigap supplement gives you more flexibility, but it costs more upfront. The right answer depends on your health situation, your doctors, and where you live. The mistake that I see most often is that people make this decision based on premiums alone. And premiums are fine, but you want a plan that's going to cover you when you get sick, and not one that is just the lowest cost option. Speaking of Medicare, gang, choosing a Medicare plan can be overwhelming. It can be confusing. Just ask anyone who's turned 65 and they will tell you that this is true. They'll spend hours analyzing all of their options and pick a plan only to find out that they didn't pick the right plan for their specific situation, and it costs them hundreds or even thousands of dollars a year, either in additional medical costs or premium. On this channel, we have 3 affiliate relationships. One is our trusted Medicare partner, Chapter. Chapter is the only national advisor that looks at and recommends every plan. They're not captive with one insurance company. They're totally free to you. They save their clients an average of $1,100 per year, and they're really easy to work with. If you have questions about Medicare, give them a call at 440-703-1224. Trap number 2, the Social Security trap at age 65. Now, this is one that is out there, and it's been out there for a long time. To be candid, I'm not even sure why it still exists, but it does. And that is, there are still a lot of people that think that full retirement age is age 65. Full retirement age for Social Security was gradually raised starting about 25 years ago. And here's where it stands today. If you were born between 1943 and 1954, your full retirement age is age 66. If you were born between 1955 and 1959, it goes up by 2 months for each birth year. And if you were born in 1960 or later, which covers everyone turning 65 in 2025 and beyond for the next several years, full retirement age is age 67. If you claim Social Security at age 65, you're claiming 2 full years early, and the reduction is not small. Let me give you some real numbers so that you know exactly what I'm talking about. Let's say your full retirement age benefit, what you'd get at age 67, is $2,500 a month. If you claim at age 65 instead, Social Security reduces that by about 13.3%. That takes you down to roughly $2,170 per month. The difference is about $330 a month. Over 1 year, that's almost $4,000 a year. Over 20 years, almost $80,000. And that's before the cost of living adjustment, which compounds on a lower base because you claimed before full retirement age. There are a lot of reasons people claim early. They claim early because of health concerns. They claim early because they want to enjoy the energetic part of retirement and they have enough money for later. Maybe they just need the money. All of those are situation dependent, and no one really is there to judge. But the important thing is that if you're going to claim early, you know that the reduction is coming. The next point is that the health savings account, the HSA account, penalty disappears at age 65 if you withdraw the funds for non-medical related expenses. Now let me explain to you what I mean. Before age 65, you could only use the funds from your HSA account to pay for medical costs. And in return for that, you paid no taxes on the funds used to fund your HSA account. Your funds grew tax-free, and you could withdraw the funds without paying taxes on the withdrawn amount. At age 65, that account behaves a lot like an IRA. And that means basically that you can take the funds out after age 65 and just pay taxes on the money that you took out, just like you would a normal IRA. Before age 65, if you took the funds out and used them for a vacation or a new car, you paid a 20% penalty on top of the tax that you would owe on those funds. After age 65, you're good to go. You just pay tax like you would on a normal IRA. And by the way, that 20% penalty has real teeth. It's double the 10% penalty that you would pay for taking funds out of an IRA early. What this means in practice is that your HSA account becomes a second retirement account at age 65. If you take the funds out for medical costs, you have a triple tax benefit. If you don't take them out for medical costs, it acts just like an IRA. Number 4, the brand new $6,000 deduction for people age 65 and older. As part of the One Big Beautiful Bill passed last year, Congress created a new temporary age 65 plus bonus deduction for taxpayers 65 and older. The amount is $6,000 per person or $12,000 for a married couple when both spouses qualify. And before you say, wait, there's already an extra standard deduction, you're right. But this stacks on top of that. Here's how the full picture looks for a married couple with both spouses age 65 or older in 2026. You start with the regular standard deduction for married filing jointly. That's $32,200 for 2026. Then you add the existing age-based additional deduction, $1,650 per spouse over 65, so $3,300 for a couple when they both qualify. And now you add the new 65 plus bonus deduction on top of that, $6,000 per person, so $12,000 for the couple. When you add all of that up, that's $47,500 before a single dollar becomes taxable. And a lot of people don't even know that that $6,000 deduction exists. There are income limits to this deduction. It's $75,000 for individuals and $150,000 for couples filing jointly. After that, the deduction starts to phase out. It drops about 6 cents for every dollar over the threshold, and it phases out completely at $175,000 and $250,000 respectively. But here's what makes this deduction so powerful. It applies whether you have a standard deduction or you itemize. You get the deduction even if you itemize. This deduction is available for tax years 2025, 2026, 2027, and 2028. After that, it disappears unless Congress acts to make it permanent. I saved the final point, the most dangerous point of them all, for last, and I'm saying this as a CPA who's actually seen this happen to quite a few people. It's the HSA backdating trap. Let me explain to you what that means. You must stop contributing to your HSA account 6 months before you apply for Medicare. If you don't, Anything from that point forward becomes subject to a penalty. Here's the part that really stings. The penalty is 6% for every year that excess contribution stays in the account. Let me put real numbers on this. The 2026 HSA contribution limit for self-only coverage is $4,400. If you contribute $4,400 during a period that was retroactively covered by Medicare backdating, you could owe $264 in year one, then another $264 the following year if the money is still in there. If you like this video, check out that video, things you can now do at age 59 and a half. Also, don't forget to give our partner chapter a call at 440-703-1224 if you have questions about Medicare. This is Jeff Schmidt, and I will see you in that video right there.